Eagleson, the medical device analyst at Wells Fargo, and it's my pleasure to host this session with the CFO, Karen Parkhill, of Medtronic. In terms of the format, it is going to be a fireside chat for 30 minutes, and we're going to try to do a couple polling questions, which have worked well so far. So, Karen, thank you so much for joining us.
Thank you, Larry. Thrilled to be here.
Great. So why don't we start, Karen, with the recent news about the new operating model at Medtronic. Can you please talk about the rationale behind it and what changes you're making in the organization?
Sure. I'm really happy to talk about that. You know, we've talked about our vision of being the leading healthcare technology company. And as we focused on that vision, we realized that we needed to change our matrix organizational structure to really realize that vision. So our new operating model, which we are beginning to make happen, is really a transformation that simplifies our structure, where we're focused on becoming more nimble, more competitive, focused on accelerating our innovation, which in turn accelerates our growth and our market share. We're also focused on enhancing our customer experience and our employee experience within Medtronic. And really the primary change that we're doing is reorganizing our 4 groups and their respective business units into more highly focused, accountable, and empowered operating units that will be organized around specific therapy areas. And this is really designed to accelerate our decision-making, drive our growth, make us closer to the customer, drive better execution. We're also centralizing our operations, and we're focused on driving even greater efficiencies within our enabling functions at the enterprise level. And that's really designed to provide greater service to our operating units and really leverage our scale. So we're really excited, and you're going to hear more about these changes directly from Jeff at our Investor Day.
That's helpful, Karen. So CVG, MITG, diabetes, and what did I forget there? I forgot RTG. Are those going away, or will you still have those 4 divisions?
You know, from a segment reporting perspective, we'll figure out if there are any changes to segment reporting. I don't anticipate any at this stage. What's really changing is the group structure around those groups, where we're driving more of that structure into these accountable operating units.
I got it. And is there one tangible difference, for example, where the sales force reports into from the current structure and the new structure that you could highlight?
Yeah, so there are some changes there. You know, currently the reporting of our sales force varied honestly by group and by operating unit. In some cases, that sales force reported directly into the operating unit. In other cases, you know, it was shared or reported indirectly. But this model does clarify the sales force reporting and streamlines that they, you know, directly report in developed markets in particular into the operating unit. So that just helps with clarification and, again, decision making.
That's helpful. Are there people, you know, with any change, there might be people who are happy about it, there might be people who resist it. Are there, for example, how are the country managers going to feel now that the sales reps reported into someone in Minneapolis?
You know, Larry, now that we've communicated these key changes across our organization globally, we are really getting really good feedback from our employees. You know, and in fact, our employees are really excited by this change and honestly the clarity that it provides. As I mentioned, we're focused on making it easier for employees to get work done. We're focused on, you know, clarifying the decision rights, and our employees are really excited about that. So honestly, we're getting really good feedback on it.
Good to hear. And one financial question. In the 8K, you put out $450 to $475 million in annual cost savings from this change. how should we think about the cost savings in the context of your comments on the fiscal Q1 call about not expecting much margin improvement at Medtronic above the pre-COVID level of about 30%?
Yeah, so we will be driving cost savings with this model improvement, and we said it's between 450 to 475. And those savings are really we're focused on having them enable greater reinvestment for us into areas as we're focused on driving and accelerating our top line growth. And those savings will also help us, ensure that we deliver a strong bottom line result. In line with our long-range plan that we've talked about before of about 8%, EPS growth, absent the pandemic that's going on right now. We're not pulling back on investing in the business. We're very focused on continuing to invest in R&D to ensure our pipeline remains full, and that as we accelerate that revenue growth, we make it consistent going forward. And so, the clear focus is on driving greater reinvestment.
All right, perfect. Karen, I wanted to transition to fiscal 2021, but before we do that, anything else you wanted to communicate on the new operating model?
I would say just that we're really excited. We're getting great feedback. And, I do think that this is going to drive an important culture change within the company that will be focused on driving greater top-line growth, taking market share, being more competitive, driving that competitive edge into the company that Jeff has been talking about. So honestly, we are really excited about it.
All right. Good to hear. So fiscal 2021, you reported fiscal Q1 results in August, late August, which came in better than expected. Overall sales declined about 12% year over year on a constant currency basis when we adjust for some one-time factors. You also talked about improving trends month over month and into August, which was encouraging. So I guess given some of the moving parts, like lower bulk purchases and all, how do you know that average daily sales were improving? And are there any data points you can share with us?
Yeah, so when we looked at just our raw revenue on a month-to-month basis, Larry, we had to adjust to really see the underlying trends. So we first adjusted for the number of selling days in each month, which were different in May and June and July, to get to the average daily sales. And then we also adjusted for the extra weeks that we had and the impact that we had on taking down our bulk purchases. But after we made all of these adjustments, our company-wide average daily sales did see a significant step up in May, then again in June, and that continued into July and August. And so we're really excited about this trend, and, we see things improving, more quickly than we had originally anticipated.
That's helpful. And you also talked about the cadence of growth through fiscal 2021 with Q2 down 9% year over year and getting to normalized growth on a stacked year basis in Q4, fiscal Q4. So first question is the negative 9% in Q2 seems conservative given that you declined 12% in Q1 and trends improved through the quarter. Is that fair?
Yeah, so what we said, Larry, on our Q1 decline was that it really was 17% on an organic basis, and that adjusted for the extra week. And when we look at the trends of decline of 25% in our fiscal Q4, and then a 17% in our fiscal Q1, and that delta improvement of about 8%, we said that we expect, hopefully some similar improvement of about 8% from that negative 17 into our Q2, which by math just gets you to that negative 9 we talked about. Could we do a little better than that this quarter? Yes, we definitely could. But it still depends on how the pandemic plays out this fall. We are seeing, good trends, and that's continuing.
That's good to hear. Karen, you gave a very specific color on Q2, very specific color on Q4, but not much on Q3. Can you be flattish in Q3 on a year-over-year basis?
We, like many companies, we're not giving specific guidance in our back half and our full in particular yet. But could we be flat? Yes, we could. It just depends on how the pandemic plays out at this stage.
Okay. Makes sense. And just on EPS, the street seems to be netting out, and I looked a couple days ago at 83 cents for Q2. I thought you gave pretty specific color that got us to about 78 cents in Q2. Am I missing something?
No, when we talked about the color we gave on, the improvement in revenue growth and the color that we gave on margins, which was really that we expect sequential improvement in gross and operating margins this quarter, your numbers are about right.
Okay. And based on your comments for Q2 in the second half, it seems like you're comfortable. I know you don't have formal guidance, Karen, but somewhere in the call it $403, $404 dollar range for EPS for fiscal 2021. Any reaction?
Yeah, as I said, we're not giving specific guidance on the back half or the full year at this time. But, we do expect revenue growth to continue to improve sequentially. And we expect, some deleveraging to continue in the next couple of quarters, but we expect to be back to more normal revenue growth and more normal margins in our fiscal fourth quarter.
Okay. And Karen, I know it's a ways off, but I'm intrigued by fiscal 2022, given some of the color you've given, because if you get back to kind of mid-single digit growth on a stacked year basis, like fiscal Q4 of fiscal 2021, and kind of apply an underlying growth of call it 4 to 5% next year, you kind of get to about $33 billion in sales, and you've given very specific color on the operating margin getting back to pre-COVID levels by the end, I think, of by the end of this fiscal year. So I guess my point is that it's easy to see, or the math kind of gets you to almost $6 in EPS in fiscal 2022, which is well above consensus. I know it's a ways out, and I know we're in a very uncertain environment. I certainly appreciate that, but be curious to get your reaction to that.
Yeah, so I'm glad you're thinking ahead, Larry. And, I would say for us, it's premature to be commenting about FY22 because our FY22 is still, 8.5 months away. It doesn't start until May. So we need to go through our annual planning process, which we have yet to start. It typically starts, in the winter time frame for us. And the pandemic is still largely an unknown. But I would say, as we think forward, even beyond this fiscal year, we feel really good about our pipeline of products and our ability to take share in an increasing number of businesses going forward. So hope you hear that, that excitement from us.
I hear it loud and clear. So Karen, and maybe we can touch upon some of the pipeline products later, but I wanted to ask about the investor meeting coming up in October. I know we can expect that to be virtual, I believe. Maybe you could confirm that. I'm assuming that. But what can we expect at the investor meeting?
First of all, absolutely, it will be virtual, and we're focused on trying to make it a really exciting virtual experience for all of us. So, you should expect at that meeting to hear about how we intend to accelerate our revenue growth and increase our WAMGR. We've talked about the robust pipeline of products that we've got, many which are coming to market now and will come to market soon, and we'll be highlighting those, obviously. We'll also lay out where Jeff is taking the organization with this new operating model, including the changes around our culture, particularly around our speed and our competitiveness. You'll also hear from many members of our leadership team around our pipeline and the strength of that portfolio. And then, of course, I will lay out our long-range outlook as well.
Okay, sounds good. And it seems like you suggested on the Q1 call that Medtronic's going to strive, again, you mentioned this just a minute ago, to increase its top line growth above the previous goal of 4%, but maintain the EPS goal of 8%. But you also said, operating margins could improve a little, but you're more focused on driving an acceleration in top line growth while maintaining, again, the 8% EPS growth. Was that the message you were sending? And if sales increased by, say, 5%, where do you get the other 3% of earnings growth?
Yeah, so first of all, that was definitely the message we're sending. You know, we are really focused on accelerating our top line, driving that to consistency, and still ensuring we deliver a strong bottom line, you know, committed to the 8% EPS growth. And when you combine that with our dividend, you know, getting to a double-digit shareholder return. You know, in terms of how we generate the leverage to move from, you know, top line growth to a greater bottom line growth, you know, we will, you know, generate leverage. And, you know, much of that may come from operating leverage. Some of it may come from financial leverage. And we still have plenty of, you know, efficiency that we can drive in the company, you know, because we're always focused on growing our expenses less than our revenue. And that drives the leverage.
Okay. So let's go with the polling questions. We're going to try to do both of them up front here at this one after the other. So, Josh, could you please show the first one? So I think everyone, so what do you expect Medtronic to provide for its long-term organic revenue growth target at its upcoming October investor meeting? And I'll let everybody read the choices here. And it's pretty easy to answer this from what I can tell, or to, you know, just click on the dial button. Karen, you can't vote.
I won't.
Okay. All right, give everybody 10, 20 seconds. How are we doing, Josh?
All right, I think we have about everyone, so we'll go ahead and share it.
Okay. Drum roll. All right, 4 to 5. I'm a little surprised 4 to 5 instead of 5, because that's pretty similar to the 4 plus. Karen, any reaction?
Well, I think you're going to have to wait till our investor day for us to comment more on that. But obviously, I've said we're super excited about accelerating our innovation and our growth and market share along with it, because we're focused on creating, you know, long-term shareholder value. Okay,
that makes sense. And why don't we do the second one, Josh? On the last earnings call, the CFO, Karen Parkhill, said Medtronic is more committed to driving revenue growth acceleration and maintaining its 8% EPS growth target than driving operating margin improvement. Do you agree with Medtronic's approach? Something is missing here. Let me tell you what's missing here. I apologize. What do you agree with Medtronic's approach to the operating margin expansion? So hopefully that's clear, to operating margin expansion. Yes, no, not sure. How are we doing, Josh?
I think we'll give it about 5 more seconds.
Okay. Again, the last part should be, do you agree with Medtronic's approach to the operating margin expansion? Yes. Okay. Interesting. All right. Well, Karen, given that you've kind of confirmed that part, I think in your, you know, comments today, that response has to be encouraging to you. Hopefully it's encouraging.
Absolutely. I'm glad you agree.
Okay. Okay. All right. Well, we have about 10 minutes left here. So why don't we talk a little bit about the pipeline? You know, I think people are interested in the diabetes pipeline and the surgical robot. So maybe, Karen, talk about the timelines. You just got the 770G approved in the United States. You have 780G approved outside the U.S. And so you have your sensor pipeline with Zeus and Synergy, and then, you have 780G we're waiting for in the U.S. Can you just remind us of the cadence here, please?
Sure. So, I'll say up front, too, that the same division within the FDA that's responsible for our approvals within diabetes is also responsible for COVID diagnostics. So obviously they're very busy. But we are working with them to determine the most efficient way for them to review all of our submissions within that business. And I would start with on Zeus, we're working with the FDA on that submission plan. Our data is ready. And we're working to identify a conference or publication where we can present that. On 780G, at the request of the FDA, we are going to submit a PMA supplement off of our 770G, which just got approved. We do have the adult 780G data ready to submit. But the FDA really wants to review that adult data at the same time that they see the peds data from us. So we're working with them right now to determine when to submit that supplement. We're pleased that the FDA granted us approval for that 770G last week. It's the same hardware for the 780G, and we really look forward to launching that product this fall.
Karen, on the 780G for the peds data, is that still in development? I just can't remember the status, because you said that you have the adult data, but they want the peds data too.
Yeah, we're still working on the peds data. We don't have it fully complete yet.
Okay. Do you know the timeline offhand? When it'll be complete?
I know it's soon, and I don't know what we've said beyond that.
Okay. And one other question on diabetes. You were deferring some revenue over the past few quarters, waiting for 770G to be approved in the United States, I believe. Karen, is there any, I don't think you've disclosed much information about now that 770G is approved in the U.S., some of that revenue will start rolling, the deferred revenue, you'll start booking it. And will that show up in Q2, fiscal Q2? And are there any precedents, because I know you haven't disclosed much on it, but any precedents with 640G and 670G that help us understand how much that revenue could be?
Yeah, I would say, first of all, we have held back some of our revenue as we work to fulfill the promises of the upgraded technology. That revenue per device is not hugely significant. And it will start showing up when we launch that product. We're working on getting the materials, the instruction materials printed in multiple languages before we launch this product. That is one of the requirements of approval. And so, I wouldn't expect much in Q2 at all. It would flow more into Q3 and Q4.
Okay.
So obviously it will help our growth somewhat, but it's not a significant needle mover.
Okay, that's helpful. And the Blackstone deal was definitely novel in the device space. So, congratulations on that. Why did you need to get the Blackstone funding instead of using your own funding? And could we see you do deals like that in other businesses if it makes sense for diabetes? Could it make sense for other Medtronic businesses?
Yes, absolutely. So we always have a myriad of opportunities to invest in R&D. And we looked at this Blackstone partnership as a really good opportunity for us to accelerate our internal R&D spend in diabetes already. And keep in mind, our spend in diabetes is already above the corporate average. And when we look at our own returns, our internal R&D is always going to drive the highest and best return. But the Blackstone deal had a better return for us than what we would see when we go out and do tuck-in M&A. And so for that reason, we're really excited about this, and we look to do more where we can. With this current arrangement we have, it allows us to accelerate our investment in diabetes in 4 specific longer-term projects, while we continue to fund our other internal diabetes R&D programs. And, it's technically neutral to us in the P&L during development, and then when we have successful commercialization, we'll pay, a low to mid-single-digit royalty back to Blackstone for a period of time. But we definitely believe this is the right thing to do, and we are excited about doing it in other areas where it makes sense.
So you will explore doing this in other areas of Medtronic?
Yes.
Okay. That's interesting. And the other pipeline product that people are, obviously interested in is the surgical robot. And I guess broad strokes, it looks like the major milestones that you gave at I think it was September of last year, in-person meeting in Connecticut. Basically, the milestones were pushed out, call it 6 to 9 months. Is that fair? And how does it impact the financial goals you gave for the surgical robot last year?
That is fair. We've said previously that the delay with the robot was driven by two things. First, some software and integration challenges that we had but are now clearly behind us. And secondly, the fact that operating in this pandemic made it difficult and harder for us to complete our preclinical testing work. But we have been focused on minimizing that delay. We feel super good about our progress. We gave the update a couple weeks ago that we expect to file for CE mark and IDE approval in the first calendar quarter of 2021. And then when we think about the revenue trajectory that we gave you last fall, that trajectory and contribution to our growth hasn't changed. It's really just been pushed out slightly, as you said, Larry.
That's helpful. So we got a few minutes left here, and we've seen you guys start doing more M&A recently. I think you've done 3 deals in the past 6 months, which is maybe somewhere in that ballpark. What should we expect from Medtronic, call it, over the next 6 to 12 months? Do you expect to be active? And any thoughts on valuations?
Yeah, so we absolutely have done more tuck-in M&A of recent. And, we believe it's the right time for Medtronic now to be doing those deals. We fully completed the Covidien integration. Our balance sheet is strong. We're focused on, supplementing our own strong organic, R&D investment by using our balance sheet with these tuck-in M&A deals. So you should expect more. When I think about valuations, those have held up through the pandemic, particularly in the public markets. And, when we think of some of the single product companies out there that are, those valuations have held up. And so they're a little expensive. So we'll have to wait for some market correction on those smaller companies. But I would say, we tend to buy a lot of companies that are not in the public market. And, we often take early stage investments in companies and do structured deals where we'll invest early on in helping to develop a product and then, have a right to buy at the end of that. So you'll see us continue to do those kind of deals. It's really an extension of our own R&D. We're focused on growing what we buy, not buying growth. And you can continue to see us be disciplined around how we do M&A to ensure that we're generating the proper returns for us and for our shareholders.
That's helpful. Let me sneak one more in here. Any thoughts? We're starting to get a lot of questions, Karen, on tax rates. Any thoughts on Medtronic's long-term tax rate? And put you on the spot a little bit here. I'm getting a lot of inbounds on tax proposals we're seeing from Joe Biden. Just curious what your thoughts are.
Yeah, it's premature for us to be giving any long-term tax rate guidance here. But, with any potential tax changes on the horizon, as always, we're focused on optimizing and we're focused on, offsetting headwinds that could come our way no matter what they are. So you should expect us to do that should headwinds come our way.
All right, perfect. And I want to give you the last word here, Karen. We've got a minute or so left here. Any closing remarks, anything you want to communicate that we didn't get a chance to touch upon?
I guess my closing remarks would be that, Medtronic is really finding a new gear here, and we are super excited about these operating model changes that will drive a more competitive culture. We're really excited about taking the strongest pipeline that we've had in our company's history to market, which we're starting to see now and is only going to accelerate over the coming quarters and years ahead. And we're really focused on ensuring that we continue to invest heavily to not only drive that growth up, but to maintain it. So I'd say it's a super exciting time, and hopefully you can see it in our faces and in our voices, and also, you'll see more of it on Investor Day on October 14th.
All right. Well, we're looking forward to it. Karen, thanks for joining us today, and good luck with the rest of the year.
Thanks, Larry. Appreciate it. Take care.
You too.